Helene, I just saw the tweet. I love it. Let's get into your charts, because even though this sell-off has only been a few days, by one measurement, if you look at some of your technicals, are we like oversold already?
Well, yeah, we've got a couple of, first of all, understand that the Russell has been going down for 5 days. The Dow's been going down for 5 days. So it's not like it's just the last 2 days in the S&P and
Sure.
the NASDAQ have finally played a little bit of catch up. But one of the metrics that I use is, well, first of all, there's the Mcclellan Summation Index, which I view as a great measure of breadth.
Okay.
And it's currently going down. And what I do is I calculate what it will take to stop going down. And I find that when it needs a net differential of 2,000 advancers minus decliners, we're sort of stepped a toe into oversold territory. When we get to plus 4,000, we've gotten a little extreme, as you can see from this chart. And as of last night, we needed a net differential of 3,500. And when you think that there's only 3,000 stocks on the New York Stock Exchange, that's a net differential of 3,500 is a lot.
So remind me here and others, for the layman technicians, what is the Mcclellan summation? What are we summing up here?
Okay, so the summation index basically tells you what the direction of the majority of stocks is.
Got it.
So when it's going down, you want to calculate what it's going to take to get the majority of stocks to stop going down and turn up.
So we've now...
And obviously vice versa. When it's going up, I calculate what it'll take to turn them down. Got
it. Okay. So we're at a pretty, as we can see on the chart, we're at a pretty elevated level, but there's a lot of different ways that you can measure overbought, oversold. For the NASDAQ, is this like the Meisler oscillator you've got? This is overbought and oversold. This one doesn't look quite as obviously, quickly moving to the downside.
Right. So for the oscillator that I use, it's in this particular one is an intermediate term one, and it is based on the 30-day moving average of the advanced decline line. And that only got overbought about a little more than a week ago. So we have a little bit of time to go there, because it's really more based on time than it is necessarily on price. And so it just seems to me it's a little early to get too excited on the oversold side until that gets more oversold.
Interesting. So
let me just back up for a minute.
Yeah.
Basically, what we've got is we had a big decline. We got short term a little excessive on the downside. On an intermediate term basis, we're not as excessive on the downside. So chances are we rally and come back down.
Interesting. Now, I like this because what you're doing is basically there's different ways to kind of measure this oversold. It's magnitude and number of stocks that are participating on the downside. And then there's, well, how quickly is this happening? So when you include the time element to it, just to clarify, when you put that perspective on, that's where it's not quite as, going to hell in a handbasket. It doesn't look quite as crazy.
So, yes, I'm fond of saying that folks rarely go from bullish to bearish or bearish to bullish overnight. They usually fence sit for a little while. And so if you think of an intermediate term indicator in that respect, you have to figure that after the last few days, there's probably a lot of fence sitters.
I like it. Now, when you consider the rest of this market, so we've got basically a few things going on here. One is we had, as you mentioned, that the Dow went basically several days red, which we haven't had in a long time. Just sort of consecutive sell-offs. Even during a big rout, so much of it happened in a few sessions. We had a little bit more chop. That there was just a general, consistent decline here. How does that factor into it when we see that there's just not as much willingness to go in and quickly buy dips?
Well, the Dow and the Russell have sort of been the weak links in the whole rally anyway.
Yeah. So
it's not that surprising that they would be the first indexes to get to their 50-day moving average lines. So, I don't know that I would make a whole lot out of it, except that there has just been a lot of selling that's taken place in the last week under the surface, and a lot of the S&P and NASDAQ just played a lot of catch up in the last couple of days.
Okay, let's go to the Russell. I like this point because the Russell's been weird. The Russell basically lagging on the way up. Okay, and then on some of these days when we look at this market, we see that you still have small caps. They're actually, when we had selling the other day, it was obviously concentrated in the NASDAQ. It seems like that kind of high beta NASDAQ play is definitely showing up on the downside. What do you see for small caps, Helene?
Well, they've just been in a downtrend relative to large caps for a long time. I mean, years. And they were actually, as of yesterday, they were down on the year or flat to down on the year. So until you start to see that stabilize, it's a little difficult to see that there's going to be a change in that trend. But like I said, it got down, the Russell got to its 50-day moving average line, and therefore it is very entitled for a bounce.
Interesting. So now, is that contingent? If we have the rest of the market, do we need to see this kind of broader type of breadth come back to lift Russell? Is that sort of a category within breadth, small caps relative to big?
Well, yes. One of my big things in the market is that if there is not a lot of good breadth in the market, then the market in general is not in a healthy situation. So you want to see good breadth in the market. And generally speaking, good breadth comes with a better action in the Russell. It doesn't mean the Russell has to lead, but the Russell does have to participate.
So doesn't have to lead, has to participate. You've got a moving average advanced decline line for the Russell 2000. Is it obviously different? I mean, when you get into sort of the nitty gritty, should we be reading something through here? Because on the fundamental side, I know people go, all right, the Russell's underperforming, domestic problems. You've got, risk problems, but we haven't really seen the Russell be that leader as we're talking about here. So whether or not we describe Russell as like, the high beta leader, I don't know if that even really works anymore. What do you see when you look at the advanced decline line here?
So, well, again, this is just an intermediate term oscillator, and I'm looking. You can see that every time it's gotten down at the lows, down near that zero line, we've rallied. And what I'm referring to here is the blue.
Okay.
The blue is the oscillator. And so what I'm looking for that to do is I'm looking for that to come down and get oversold, and that just takes time.
All right, we need to wait, basically. We need to wait for the market to clear itself of some froth. In the meantime, Helene, two very simple ones. Even I can understand this, all right? If we look at the VIX over the past year, and I love that you brought the VIX chart, because actually I've been looking at this too, and I don't know the rules here. Can you do technical analysis on the VIX? Because one of the things I noticed is like every sell-off we got, volatility was not popping as much until this one, where all of a sudden we jumped and we kind of broke this trend.
Right. So I'm a strong believer that the VIX tells you something when it gets jumpy. And jumpy is a very subjective term. And so it's to me, it's when the VIX looks like it's breaking out as if it were a stock chart and you'd want to buy it. To me, that usually corresponds to a low in the market. And to me, the VIX started to get jumpy yesterday.
We actually were talking about this too. Volatility was surging in a very quick way. You had VIX futures that inverted like in a snap, in a strange fashion. So the idea here is that this is almost kind of another oversold type of metric where the speed and the momentum to the downside happened so quick. VIX popped us back to above the last three bouts of choppiness in the market.
It's pretty common that when you get a decline, I mean, we opened on a gap down yesterday after being down pretty hard on a Friday. So it would have been very unusual if the VIX had not jumped up yesterday.
Yeah.
Then I would have thought it was quite bearish.
Yeah. All right. Hey, before we let you go, overall, if this market keeps dropping because we got so elevated, whether it's moving averages, whether it's trend lines, it looked like we were, up in the higher ranks here of, distance from these lines. So, Helene, does that mean we've got sort of a buffer zone? How much weight do you put on moving averages, stuff like that?
The only weight I put on a moving average is the direction of the moving average. So if you break, let's just say a 50-day moving average line, and the moving average line is still rising, then it doesn't tend to act as resistance as much on the re-rally the next time you come back up. But if that moving average line rolls over, then that becomes a lot more resistance on the next rally.
And which one do we have right now?
They're still rising. They're still rising. About 50 trading days ago was early November. So as long as the current price in the market is trading about higher than it was 50 days ago, the moving average line is still rising.